find them, Adrienne? Send them over to me.
You know what? It's a group called Lake Powell Heads with a Z. And they post stuff every day about like what's going on at Lake Powell, the water levels, and just cool stuff happening there. And they're the ones who posted that video of the boat sinking yesterday.
I'll have to take a look at it. I'm fascinated to see it.
Yeah, you should look at it. It's cool.
All right. Well, it's the top of the hour. Here we are. I'm super excited to be live with you all. I believe we are now live streaming to Facebook. The numbers are climbing. Want to thank all the panelists. Want to thank all the attendees and team. Look, we plan to be very active in the chat. So if you're on Facebook, feel free to put questions there. If we can't answer those questions live, we'll come back and answer them later. If you're in the Zoom link, please put your questions in the chat, and we'll do our best to either pause and answer your questions, or one of the panelists, if it's in their area of expertise, they'll just go ahead and answer it for you. We want this to be as interactive as humanly possible. So team, here's going to be the format, just so you can know what to expect. Jake and I are going to take about 20 minutes and roll through what we think of as the macro factors that are impacting real estate, mortgage. We talk about everything from inflation to loan quality to default rates, all those types of things that are kind of the underpinnings of the real estate and mortgage market. And then we're going to get micro. We brought experts from all around the country because real estate is such a geographical area, and it's so different in every geographical area. So what might be, booming in California is coming to a screeching halt in Florida. And we want to know coast to coast what is happening in the real estate market. So with that, I will kick us off. I'll share my screen. And again, hope that this is an interactive experience for everybody. Feel free to leave your chat and questions in the chat. Panelists, when I throw up my screen, if somebody will just give me a thumbs up, let me know that you can see my screen. All right. Thanks, Alex. Thanks, Adrienne. Gotcha. Okay, team. So the question that we hear from clients all the time is around the fear of what's going on in the market. And are home prices about to implode is the question that we hear the most. Now, what we hope to do over the next hour is to help move from conjecture and fear, which is what we hear from a lot of clients. And there's good reason behind that. We're gonna validate that. And we're gonna show you, where that comes from. But we want to move from conjecture and fear to data-driven confidence. Confidence to either buy or not buy. That's fine. But we want you to know the information. If you're thinking about buying or selling, you should know the real data. And that's what we hope to bring you here. But first, I thought it would just be humorous. Let's dig into where this fear and conjecture comes from. So these are quotes from Diana Olick. She is CNBC's senior real estate correspondent. And I think it's just fascinating how wrong the media has gotten the real estate market over the last 7 years. And I think they equally have it wrong today. But we hope to give you a fair and balanced look at that data so you can decide for yourself. Let's go back and just look at a few quotes. 2015, housing today, a bubble larger than 2006, conjecture. August 2016, we're in a new housing bubble, conjecture. 2017, homeownership doesn't build wealth, study finds. Rumor. I can't say if there's any fact there. Let me explain these other columns before I go down the rest of these headlines. This is the amount of appreciation nationally each of these years. So here's the year the quote came out. Here's the quote. Here's the amount housing went up or down. They happen to all go up these years. And the amount of equity gained, and then the median home price over that period of time. And so you can see we have a lot of conjecture and a lot of opinion and a lot of fear, and it was really, really wrong.
I think interesting too, Josh. Guys, if you look and zoom out of that graph, that's a 6-year time frame. And if you go back to the October 2015 quote, and median price across the country was $315,000, for a single family home, the lost appreciation over 6 years is almost doubling home price in 6 years.
Yeah, it is staggering. So here we go. Next year will be hard on the housing market, especially in these big cities. Fear. We better not buy. We better stay out of the real estate market. Except what happened next year? Oh, we had a 16% appreciation year, and then we had an 18% appreciation year. And the most recent appreciation numbers that just came out of Case-Shiller yesterday showed 20.4% appreciation from May of 21 to April. It was the April report from April of 22. So the point we wanted to make is fear and negativity around the real estate market is nothing new. What you're going to hear this year is the same narrative that has been going on for the last 7 years. And had we listened to that narrative, it would have cost the average homeowner $222,000 of appreciation. Now, team, remember, the first $250,000 of your housing gain is tax-free. If you're married, your first $500,000 is tax-free. Check with your CPA, make sure you qualify for that. So $222,000 of tax-free appreciation is like losing $350,000 in income due to this negative narrative. So we just want to point out that the media has got this wrong for years. Our goal today is to give you fair and balanced, objective reviews of what's happening in the housing market. Now, the first thing I want to try to explain is not just what's happening in the housing market in terms of the price increase, but why. I want you to leave here understanding why the market is moving the way it is. And this helped me a ton. This shows the current amount of US money supply. This is the number of dollars in circulation in the entire US economy in trillions. So if we fast forward to 2022, we have about $22.4 trillion in money circulation. But what I find really interesting is to go from roughly zero in 1959 to 5 million in 2001, 5 trillion, that's 12 zeros, team. To go to 5 trillion, that took us roughly 42 years. But to double the money supply from 5 trillion to 2 trillion only took from 2001 to 2012. So it only took 11 years to double the money supply again. And then to get from 10 trillion to 15 trillion only took from 2012 to 2018, 2019. And then from 2019 to double the money supply again, well, that only took us 2 years. So we have a massive expansion of money supply. This is what, when you hear the Federal Reserve doing quantitative easing, they are printing more money into circulation. And if we listen to a quote from my favorite economist, Milton Friedman, Milton says that inflation is always and everywhere a monetary phenomenon in the sense that inflation is and can be produced only by a more rapid increase in the quantity of money supply than in output. Simply said, if you create more dollars than you do products, then the cost of the products will go up and you will have inflation. So why have housing prices gone parabolic? Well, we see these massive appreciation years. Well, they correspond perfectly with the amount of massive monetary printing and the quantitative easing. And so, team, if we take this sentence from Milton Friedman, a more rapid increase in the quantity of money than output, as it relates to housing, that output is housing construction. That's the number of new homes being built. And we had a bit of a perfect storm here. If you go back to 1959, this shows us the number of US housing starts. The blue line shows you each year the number of housing starts, and down the left-hand axis, this is in million. So 1,400 would be 1,400,000, well, add 3 more zeros there and you get to 1,400,000. That's the number of housing starts. So each year, going back to 1959, the average number of new homes was roughly 1.5 million. Sometimes it was more, sometimes it was less, but we averaged about 1.5 million new home starts from roughly 1959 to, let's call this about 2000, let's call it about 2004. And then we built way too many homes leading into the Great Recession. And then when the Great Recession hit, home building absolutely collapsed. We went down to just over 400,000 homes being built. That's a million short. That's 1,100,000 short of what should have been built. And if you look back over now, what is really 13, 14 years, I guess 13 years, excuse me, you'll see that this number of years that we've been under building, we haven't filled that hole yet. And so we had the perfect storm. We had a rapid expansion of money supply. We had a reduced number of output or homes being built. And as a result, we saw this parabolic move in housing values that many of us couldn't explain. Many of us, even in experts in the market, I remember Jake and I'll introduce Jake and turn it over to him in a few minutes here. Feel free to interject, Jake. But Jake and I would have many conversations going, we can't believe how fast the housing market is moving with appreciation and how low inventory is. But this starts to make a lot of sense once we look at it in this way. I want to go back to the fundamentals of why home values go up or down. And this is true with any asset team. It has to do with supply and demand. So what I want to try to do over the next few slides is I want to show you supply, and that'll be illustrated by the NAR, or National Association of Realtors, total inventory data. So this is inventory going back to 1992 over the last 30 years. And this green line is kind of the trend line. This is the inventory trend line. So we can kind of see when we're above average or below average. And over here, this is the number of homes listed for sale. Again, at the top of the axis, that'd be 4.5 million homes. At the bottom, we're looking at 500,000 homes. So you understand what those numbers represent.
Also, for those that are maybe data geeks and maybe scrutinizing graphs and charts, you'll see different sources we're quoting, and these are the most accurate sources for that type of data. And I've often questioned if local MLSs are really capturing most of the home sales, or if the NAR data is capturing, as this one's displaying, all of the active homes for sale. I was at an NAR convention a couple of years ago, it was right before COVID, but their data capture with active listings, it at the time is 97.2% accurate. So they're getting a very good number of all the homes available in the United States.
Yeah, thanks, bud. Appreciate the clarification. And Jake, on your chat, I think your chat might have just gone to just me, but I really liked your comment. So just heads up there. So what's important?
Somebody has a question in the chat box there, so check that out if you get a chance.
What was the unit again on the y-axis on this total inventory slide?
So right now, the number is right around 1 million. We're right here in 2022. If we look at kind of the peak of the inventory surplus before the Great Recession, inventory got up to 4 million. So hopefully that answers the question. This inventory is homes for sale. Yeah, exactly, Jake. Thank you. So what we can see is one of the big factors that led us into the Great Recession was the fact that inventory numbers got massively extended upwards of 4 million. And currently we're in a very different place. But what I want to do is I want to show you a couple of different graphs, and I'm going to overlay them. Now, this is year over year U.S. house appreciation. The red line indicates zero appreciation. So your house value didn't go up, your house value didn't go down. That was a zero appreciation line. And we can see after the Great Recession, we had a drop nationally, more in some areas, but nationally home values were going down at a rate as much as 10% per year. And if we fast forward to today, we have home prices going up, according to the last Case-Shiller, 20.4% over the last 12 months. But here's what's interesting, team. I want to explain those slides. If we overlay these two slides, it's going to give you massive insight to what drives the real estate market.
Josh, go back real quick before you show it.
Yeah.
All right, guys, just pan over to 2020 to 2022 and look at that spike. I cannot tell you, because Salt Lake looks very similar. I'm in Utah. I cannot tell you how many times I've showed a last 2 or 3 years appreciation graph with just this data to clients, and people immediately throw their hands up and like, oh, bubble's gonna burst. Pricing's way up, too much appreciation. It's gonna burst. Look at that graph. So let me just set that premise, because I've found, you've all heard the kind of quote about statistics that you can skew them to say whatever you want to say, and that's what good salespeople do. Well, you can't really skew a lot of statistics brought together that tell an accurate story. And if you only have one, you can come to some crazy conclusions.
Yeah, great point. The question in life is always compared to what? And that's what we're going to show you here is if we lay these graphs over one another, this is a lot to take in. So let's start at the basics here. Inventory is the black line, all right? And on the left axis here, you have the number of homes listed for sale. So we can see that, if we go to, just for example, 1998, we had roughly 2 million homes listed for sale, just so we understand that. And the blue line is appreciation. Now, again, the green line is our trend line for inventory, and the red line is the zero appreciation line. Now, this gets a little hairy, but you're going to be able to figure this out super, super quick. If we go back and look what happened in the Great Recession, we saw inventory go up to 4 million homes, and we saw home values or appreciation go down. They have an inverse relationship. Typically, when there's oversupply, you're going to have sellers that need to reduce their prices, and that causes us to have negative appreciation. In this case, in the Great Recession, that's exactly what happened here. But then something very interestingly happened. We started to see this black line, or the inventory, dive. We got below 2.5 million homes. We got below the trend line. Remember, the green line is the trend line for inventory. And as soon as we blow below the trend line for inventory, now we're talking about, 2 million homes-ish listed. This up and down team, this is seasonality. There's always more homes for sale in the summer. There's always less in the winter. It happens every single year. So as soon as the black line, which is inventory, broke below the green trend line, we start to see pretty incredible appreciation. We're at 5-10%, all the way up to 20%. So here's the big point I want to make with this data. This market is different than 2006, 2007, because in 2006, 2007, you had this massive buildup in inventory of 4 million homes for sale, as compared to today, and we have about 1 million homes for sale there. So that's a very different, and it's the lack of supply that's one of the factors that's causing this massive appreciation.
Josh, let's address a question that I just answered. So a great question was, what changed the last 2 years with respect to the market to see that spike in appreciation other than low interest rates? And I think Josh just nailed it on supply and demand. And that is the big economic factor. That's what economists, that's what the news dive to. But I made a response that there's also the other side, not necessarily the data-driven side that you can put your thumb on, but I can tell you, being in the streets, and I'm still actively in the streets. In other words, I'm still actively selling homes in Salt Lake City, and I hear what consumers are saying. And COVID, shockingly as that sounds, COVID actually exacerbated the shortage of supply and appreciation. You might ask why, but consumers decided they want to own instead of rent more during COVID. They decided they want to have more privacy and upgrade the larger yards, or went back to, there's NAR data to back this. In the last 2 years, the average home size, square footage wise, has actually increased because people instead of a decade-long trend to downsize, people wanted more room in their homes because of COVID, because they spent more times in their houses. Also, international relocation is something that I haven't found any statistical data-driven company really been able to put their thumb on. We're probably one of the best. I'm at Berkshire Hathaway. We track this stuff. But there are markets that during COVID, over a third in Park City, Utah, 38% of the incoming buyers during COVID were international buyers. So we're also seeing that in migration. So there are many other factors that add fuel to the fire on top of what we're just showing you here in this graph.
I would add inflation to that, Jake. The value of the dollar. I mean, I just paid $8 for organic eggs and $6 for premium gasoline. The value of the dollar because of the inflation, just, the homes are expensive compared to what? Compared to the dollar that's less valuable, right? So we have to ask that question. So team, I just want to go over the most recent numbers. This comes out of the National Association of Realtors and the Case-Shiller Home Price Index. So these are the main numbers, the most recent numbers available. On pace to sell 5.41 million homes in 2022. That's down 3.4% month over month. So the pace of selling homes is slowing slightly. Now you'll hear this in the news. Home sales dive or home sales are, crashing. Well, that's the number of sales they're talking about, not home values, and down 3.4% month over month, down 8.6 year over year. So a little slower than last year, but remember, interest rates have doubled. So this makes pretty darn sense. I'd say that housing stood up pretty well. Here's a little bit of information nationally on inventory. Month over month, as compared to the previous month, which would have been April, inventory is up 12.6%. But keep in mind, inventory always goes up in the summer months, just like it did this year, just like it did this year, just like it did this year. That's the normal seasonality of real estate. There's currently, according to the National Association of Realtors, 2.6 months supply of housing inventory across the nation. That's compared to 10 plus months when the Great Recession occurred. So still very subdued inventory. We're going to get micro and show you the micro inventory numbers here in a minute too. Average number of days on the market in the United States, 16 days. 16 days before your home is sold. And 88% of listings are sold in 30 days. So homes are still, if they're priced right and they're decent value, meaning you're not just crazy overshooting, they're selling very fast. And like I said, Case-Shiller Home Price Index up 20.4% year over year. Two other things that I thought was interesting. 26% of all homes in the month of May sold in cash, 28% selling to first-time home buyers. So that inventory number only tells part of the story, team, because even though the National Association of Realtors tells us there's over over a million homes listed, which is obviously, the lowest number we've seen in going back 30 years. But the reality is 55% of those are under contract. If we look at information from the Federal Reserve economic data, called the Federal Reserve Economic Data on housing inventory, they show that the number of inventory is only 516,000 active listings, because the National Association of Realtors says all homes listed, whether they have an offer accepted on them or not. Fred boils it down and says, no, we're only going to show inventory as what's actually for sale, because we know most of those homes that have an offer on them are going to close. And team, as of the release of this data in May, we have only an increase of 140,000 active listings in the United States. And this is the lowest inventory ever in the history of our country. So there's still very low inventory. One last comparison to 2007, because people, like you said, Jake, they say, this appreciation's crazy. It feels like 2007. Well, let's look at the differences. There's 14 million more households in the US. In 2007, there was 116. In 2021, there was almost 130 million households. So we have 14 million more households. but we have 3 million less homes for sale. Instead of 4 million inventory, we have 1 million inventory, and 55% of that million inventory is already under contract to be sold. So this is absolutely a very different market. One last slide that'll show you the stark contrast from 2007, 2008. This is equity. This is this black line is the left axis is trillions, and this is the amount of household equity in the United States. There's $40.6 trillion. Excuse me, let me rephrase that, team. I'm sorry. This is total housing value, 40.6 trillion. The gold line is outstanding mortgage debt. That's how much debt are on those properties. And the blue line is the amount of equity. So you'll see if we go to 2007, let's call it, we had about 11 trillion in debt on 25 trillion in value. So the amount of equity that the homeowners across America had was about just under 15 trillion. But if you fast forward that today, and by the way, look how mortgage debt has not gone up. It's almost lateral going all the way back to 2008. So for 13, 14 years, we have Americans not using their homes like an ATM machine. So today you've got 12.8 million in debt, 40 trillion in value. Think of this as if it were one single home. So let's drop 8 zeros. Let's not say it's all the houses in America. Let's drop 8 zeros off a trillion, because a trillion has 12 zeros. And let's just say you owned a home worth $406,000. You have a home, you owe $406,000. It's worth $406,000, and you have a mortgage of $128,000. What are the chances that you're going to have to fire sale a home that has that kind of equity? The country only owes 31.5% in mortgage debt as it relates to the total value in the housing market. So there's so much equity that even if there was a pullback in prices, you have so much equity that you wouldn't see the kind of short sale and foreclosure activity that we did in 2006, 2007.
What we're not adding to that too, guys, is obviously stricter lending standards, which we're well aware of that have occurred since the Great Recession. We just didn't have time to dive into that. And also the consumer habits that we learned during the Great Recession. And as Josh kind of skimmed over, people not using their homes as much as an ATM. One other thing, about a third of the homes in America are owned with no debt. So that is only factoring homes with debt, and they're lightly leveraged, but a third have no mortgage.
Yeah, very well said, Jake. And to your point around lending standards, that's exactly what this slide speaks to, Jake. And if you go back to 1999, we have this housing credit availability index, which is put out by the Mortgage Bankers Association. And it analyzes for us the amount of risk in the mortgage market as it relates to the product risk and the borrower risk. So let me give you what that means. Let me explain that. Product risk is the old type of loans there was before the Great Recession. It was a negative amortizing loan. These were available where you could pay less than the amount of interest that was accruing. So instead of your balance going up or down each month, your balance on the loan would go up each month. Sometimes they had 2-year fixed periods of interest rates with those low teaser rates that would then catapult up, but they had 3 or 5-year prepayment penalties. So the value of your debt was going up each month because of the negative amortization. And if you tried to sell or refinance, you had a huge prepayment penalty. Loans at this time didn't have to prove income, didn't have to prove assets, didn't have to have very good credit. I say you either had to be able to fog a mirror or spell your name, but not both. Either one of them would have got you in a mortgage at that time. So there was a lot of product risk. And then we had borrowers that were taking on a lot of risk because they were overstating their income. They didn't have good credit scores. And so if we look back after the crash, now there's no product risk. Why is that? Because you get a 30-year fixed, a 15-year fixed, or maybe you get a 10-year ARM, but it's fixed for 10 years. There's no prepayment penalties. You have plenty of times to sell the home or refinance out. So there's no product risk anymore. and the borrower risk is very low. And you'll see that through even back to 2008 here, credit standards have actually tightened, not loosened, since the Great Recession. So the indebtedness, that 12.8 trillion in debt in the country, it's not toxic debt. It's amortizing debt. The balances go down every single month, and that's why you're seeing the discrepancy between the debt and the equity. Jake, I'm going to leave it this last slide, and then I'm going to tee you up, buddy. This is cumulative real estate appreciation going back to 1991. So just over 30 years of appreciation. And I'll kind of leave you with this quote. I was doing a podcast interview with Brian Grimes, who's the CEO of a national real estate investment firm. And he said to me last week, he said, those who buy and wait become wealthier than those who wait to buy. And I thought, oh my gosh, what an easy way to say it. Those who buy and wait are wealthier than those that wait to buy. And if we look back over the last 30 years, 290% appreciation in California, 230% in New Mexico, 290 in Texas, 556% in Utah. So over the long term, if you buy and wait, you'll always do well in real estate. But Jake, let me turn it over to you real quick. I have to do my disclosure so I don't get turned into the division of real estate. There we go. Check that box. I'm going to turn it over to you, buddy, and take it away.
Perfect. Thanks, Ben. Just a very brief history. So you maybe have some more confidence in the data I'm sharing. Been doing this 20 years, managed 2 luxury brands. I'm a national public speaker for Berkshire Hathaway. I've also ran a few committees, one of them being what's called the Rethink Council, which is the top 20 under age of 35 producers in the national network. And I was on that group and then led that group for 4 years. So I only bring that up because it gives me real insight on a macro level. And obviously, I do believe in my local market, and on a micro level, I'm an expert in the market. And I like to tell people that both Josh and I do put our money where our mouth is. In other words, we are investors in real estate, and we've kind of covered the gamut of any possible type of investment or asset class you can do in real estate. And we've made a lot of mistakes and learned a lot of lessons, but we are experienced from the streets as well as the books. Josh, if you can go to the next slide. I'm actually going to tee this one up by answering a question that was posted in the chat just a bit ago that said, will people upgrade their homes at 6% mortgage rates where they are now if they already have a 3% rate? And knowing that housing prices have spiked in the last 35% in the last couple of years, and consumer confidence is low. I think oftentimes people doing a presentation like this might just kind of gloss over that question. And I'm going to hit the nail on the head and address it because I think that's the question that's on everyone's mind. I asked that question, like, who the heck is going to upgrade if they're already locked in at a 3% rate? I can tell you the short answer is yes, they still do. I mean, even in the Great Recession, which we all looked back to those numbers painfully, at the bottom line is people still bought and sold real estate. And I think the first question to ask when you're asking these kind of questions is, if you're a buyer, what is your purpose in buying? Are you putting on your investor hat? Is this purely for a return? Are you putting on your second homeowner hat? And this is going to be for vacation and a possible investment? Or is it your personal home? I can tell you, defining that makes people's decisions very drastically different depending on what you're trying to do. So in my market, yes, inventory compared to what it was June of 2021 is more than double. Okay, so if we pulled up a graph, it would show that same spike that gets everyone scared. And if you look at just that piece, you'd say Salt Lake's gonna crash. But let me put that in grand perspective for you. And I'll just give you quick numbers because we don't have a ton of time. But in the Great Recession, we got to a point that there was over 10,000 homes on average for sale in Salt Lake County. Last June, we had 936, which was a 9-day supply of housing at the time. And this June, we have 2,020, still less than a 30-day supply. So although it's more than doubled, we needed that to happen. 20+% appreciation is not sustainable, as we know, and nobody's happy about inflation prices. Our median price is now $540. That's $261 a foot for those that are comparing markets. And even with this slight slowdown and less homes going under contract and more than double the inventory, we're still averaging 8 days on market. And that's not a skewed number, guys. That includes all sales, including luxury homes. And when we're talking just Utah, we are the #1 state for population growth. If you look at it in the last decade, this was 2011 to 2021. And just bolstering our market, if you saw the money that's being poured into our market, some of the largest construction projects in the nation are in Utah, including the expansion of our international airport, which will now be first or second Delta hub in the world, and our prison relocation and global logistics center. Combined, it's over 20 billion of development. The global logistics center is a big deal. There's only one other one that's in Chicago in the United States, and that allows, it's 800 acres large with another 1,300 developable acres for industrial buildings around it. And it allows shipping companies to port shipping containers off ships directly to these facilities and not have to sit at customs at a port in California or New York or these other locations, and bring them straight into Salt Lake City, Utah, and be quicker, because we all know that's a bottleneck for supplies right now. And that's another thing that's hit us and what's risen pricing during COVID. Just a few other key unique things about our state. There's many ways to say it, so I didn't want to pull up all this data. Some of the top ones that I like are at the bottom with gross state product, population growth, and business growth rate. But suffice to say, there are many different ways in which Utah ranks top 5 states in the nation for population, business, estate growth product. And one other thing I just kind of threw in here as a unique statistic. During this recent softening, truth be told, I saw this coming a full year ago. Why? I do what's called data outlay for Berkshire Hathaway for the state of Utah. We have 31 offices. I track every month what's going on. And last June of 2021 was the first month over a 6-year period that I saw unit sales in Salt Lake City decline from where they were same month in the prior year. First time. And I went, And then when that happened in July, August, and September, I said, it's not a blip, this is a trend. And the reason news and business owners were not talking about it at that time was simply because home appreciation had kept the amount of sales volume, the total amount of real estate flowing through these companies at peak all-time highs. So no one really thought about that. So yes, true, sales are down. And as everyone's wisened up the last 90 days and gone, what is happening? Or is the sky falling? Or price is about to implode? You can debate that, but I've often heard people say, well, no one dare touch luxury or this high-end luxury. I can't tell you how many times I've heard in the last couple months that it's going to blow up, it'll implode, no one will buy. Well, this is in the last 30 days, roughly 30 days, we had a record sell occur in one of our ski markets, 39.6 million for a ski in, ski out property. I'll keep answering questions, but that's all I got for you in Utah. And I want to give the other panelists time for their local markets.
Jake, thanks, man. Appreciate that. Super insightful. We're going to take it over to Alex Vasquez from Las Vegas, Nevada. Alex, great to have you with us, buddy. How are you?
Thank you very much. I'm doing great. Thank you guys for having me.
You bet. Do you want to kick off with a quick introduction and then I'll roll through your slides?
Absolutely. So my name is Alex Vasquez. I am an agent here with Coldwell Banker Premier Realty. I lead 2 teams here, 2 real estate teams here in Las Vegas, Nevada. One of them new homes team, another one resale and development. I've been a Las Vegas resident for 31 years now. And recently, 2 weeks ago, I was awarded for the third time in a row, 40 under 40. top 40 under 40 Las Vegas realtor agents just in time because I'll be 40 in a couple of years. I was going to get kicked off anyway. And then I'm also part of the Latin Chamber of Commerce Board of Directors, which means I'm a heavy participant with all the meetings, what's going on, businesses that are trying to come to Las Vegas, and very active in that field. So that's my background, and we'll get started with some highlights for here in Las Vegas. So very similar to what Jay was saying in Salt Lake City, we also have had a huge increase, over 100%. And in our case, it's about 125% increase from June of last year compared to June of this year. Our current median home prices sits at $482,000. Our average price per square foot at $262, and average days on market for 15 days. We rank currently number 4 in the country for investors, large REIT activity. Pretty much every listing that my team and I put on the market, we're getting cash offers anywhere from $20,000, $30,000, $40,000, even above appraised value for those homes. Current building infrastructure and investments sits at 22 billion, which includes the Madison Square Garden sphere, which is for those of you that are familiar with Las Vegas, just behind the Palazzo and the Venetian. Fontainebleau, also on Las Vegas Boulevard, and Elon Musk and his Boring Company are building a huge underground tunnel transportation with all sorts of Teslas in between all of the strip casinos, going all the way to downtown and coming back south all the way towards the airport. So that's going to be really, really cool here in the near future. And Las Vegas Convention Center, we are now the top convention center city in the United States of America. Our recent notable openings or investments were Raider Stadium, which will host the Super Bowl in 2024, and Resorts World, which opened, and it's the largest and most expensive resort to date, sitting at $4 billion. For those of you that haven't been, come check it out.
Hey, Alex, I got a quick question for you. Why do you think Las Vegas is the largest REIT activity?
It's just the amount of people that are coming to Las Vegas for the affordability, and especially hit by the Californians, Josh, has a huge impact on that. So they're seeing the activity, the Californian home prices, right? $500,000, $600,000, $700,000 for your average price in SoCal. And then you see in Las Vegas, we were at 300, now it's 400, almost pushing 500,000. Very affordable. Our huge percentage of our sales are to California buyers.
Got it. So you've got a lot of renters probably that are moving in there, and the REITs are just scooping them up to rent. Correct.
A lot of Californians coming in to rent as well.
Makes sense.
Our next
Anything
slide.
else here that you want? Or you want me to go to the next one, buddy?
Nope, I'm all done for this page. Thank you, Josh. And the next one, last two highlights, moving destination, will rank 2 for market relocation, only trailing Houston, Texas. You see all of the cities there on the left in the graphic. And recent highlights, one of my childhood heroes, Oscar De La Hoya, just purchased a $14.6 million home here in Henderson, Nevada, which is one of the 3 cities in our valley. It's in the southeast part of the valley. And we set the Las Vegas Valley home price record last year, also in Henderson, $25 million. There's yours truly taking a picture from the master bedroom and all of the strip in the back. And something that I did not add on here is Mark Davis, the owner of the Raiders, is also building a mega mansion. We don't have all of the details, but he purchased 2 single acre lots, so a total of 2 acres, to build a mega mansion that's going to be somewhat similar in architecture to the Las Vegas Raider Stadium. So it's going to be pretty cool.
Wow.
And
Alex,
I'm
keep
sorry.
going, buddy. Sorry.
No. That was it. That's also in Henderson. So Henderson, many of you have heard of Summerlin. Those are the 2 more exclusive communities. Summerlin is the top in the top 4 master selling plan communities in the United States, and Henderson is right up there as our 2 top communities to move to.
Well, there's plenty of money still flowing into Vegas, it looks like. So thanks for that overview. That was tremendous. Really appreciate you and all the data. And
Thank you.
I think we're going to take it over to Mr. Kyle Draper in Los Angeles, California. Kyle, how you doing, buddy?
All right. I'm doing very well, guys. Thanks for having me. I run a team called Serene Team at Ambiance Realty. I also have some co-ownership of the brokerage Ambiance. We are at 11 agents currently, and we kind of have a niche with first-time home buyers. So it's an interesting market in Los Angeles. Could you skip to next slide, please?
You bet.
So we actually have seen fewer listings hitting just May 2021 to 2022, which is interesting. And median price point, this is just for Los Angeles City. So these numbers are going to be a little bit lower for like all county. This was just pulling city though. It was kind of tricky to add all these areas, pulling this data from the MLS. So these are very high price points, some of the highest in the country. 23 days on market. Now, our MLS, if you go under contract, there's different statuses, and one of the statuses, even when you're under contract, continues to count days on market. So that this number is skewed a little high because of that. So I would probably say that most homes are getting snatched up in probably about 2 weeks or so. And then we are starting to see right now some like the opportunity to get deals under list price. We're not seeing prices going down because there's a difference between, obviously, like if list is up here and it sells here, that's very different than the price is just trailing like that. But we are starting to see some opportunities, and it really is coming down to us. Could you go to the next slide, please?
Yes.
It comes down in Los Angeles to the fact that like we have just so many different micro neighborhoods. 107 is a figure that I pulled from realtor.com. And so it really just depends on what little pocket that you're in. A lot of the pockets that I work in, this would be like Northeast Los Angeles or Echo Park, Silver Lake, kind of near Dodger Stadium, if you guys are familiar. Those are still just red hot, absolutely on fire. Everything's going well over list, maybe like it's not uncommon to see 140% over list still. But then other areas, especially if you get a little further out, maybe more like the San Fernando Valley, a little less like prime real estate, that's where we're starting to see a little more of the shift coming in here. And, again, we're not seeing prices going down, but we're definitely seeing a different market from what we were coming out of the last 2 years, which in my opinion is a really good thing because buyers can actually get offers accepted on homes they like now. What a concept. Some other LA kind of factors in our market. SoFi Stadium, that is the Rams Chargers Stadium, is finally constructed. It is so cool. If you're in LA, I definitely recommend going to a concert or a game there if you can, because it is just state of the art. And so that's down in Inglewood, which has really transitioned to Inglewood big, especially if you're in close proximity to the stadium in Inglewood. You're going to see values just continuing to really boost from that. And then, comparing Los Angeles to other markets throughout the country, we have incredibly tenant-favored laws when it comes to rent control. And so that's where other parts of the country, you're definitely going to be able to get better cash flow, because you're really limited to how much you can increase the rent in Los Angeles. You can't just like kick people out or anything like that. But the appreciation historically in Los Angeles is some of the best that you'll see in the country. So that's why it still is very desirable for the investor side to be focusing on Los Angeles. And then number 4 here, we've got a big push on living denser. Los Angeles is a very sprawled kind of city, but there are just so many of us that there's a lot of legislation. Accessory dwelling units are super popular. Those are the like, garage conversion or granny flats. And then small lot subdivision, like they're making it legal to subdivide your lots, kind of live a little more vertically. Small lot subdivision homes, they're not townhouses. There's actually 6 inches of air gap in between. So you technically do own your house, even though it kind of has a townhouse feel to it. So that's a big kind of just trend in the Los Angeles market. There's Frank Gehry, the world famous architect. His kind of swan song project is the LA River Revitalization Project, which if you guys know what the LA River is, it's a concrete drain, but they're actually going to make it really beautiful. You're going to be able to like kayak down it. And actually some of the markets that I really focused on in Northeast Los Angeles, that's where the epicenter of it's going to be. So we're going to see just big booming over the next probably decade because of that project in those neighborhoods. And then, one final note here for Los Angeles is that, especially with the sprawl that we've historically had, we never had a nucleus until maybe 10 years ago or so, where downtown went from a place where people would go to work, they'd have their corporate jobs, they'd go, and then you did not want to be there at night. It was like a ghost town and high crime, and now downtown thrives. It's really great. And so we finally have a nucleus, and that's really kind of just helped, I think, all the surrounding areas start booming and kind of just anchor our city a bit better.
That was awesome, Kyle. I think you kind of answered one of the questions that was in the chat that Jake responded to as well, but I'll just read it. Tracy said, with too many humans and not enough homes, two of the largest generations in history at the same time. I think she's referring to millennials and probably baby boomers. And based on birth rates, still 15 million millennials coming to market in the next 3 to 5 years. Where do you see affordability coming into play? And I think you touched on it there with your comment number 4, constant push to live denser, ADUs, small lot subdivisions, just more density is really the only solution that I'm seeing for more affordability. Do you agree with that? What else would you add?
I do agree. I don't really know what else there is to add to it. I mean, that's just the only way that this is going to be possible is, we're just going to have to be living closer with each other, because there's very few good developable land lots. So it's really more like working with what we have rather than, just building, with land that hasn't been developed yet.
Yeah. And I think a lot of other cities are going to follow that path that Los Angeles is already well ahead of us in, which is changing those laws. I mean, currently there's a lot of restrictions in a lot of cities around ADUs, and there's a lot of restrictions around density. And sooner or later, if they want affordability, they're going to have to loosen some of those laws, which it sounds like LA has been pretty aggressive to do.
Yeah. Let me respond to a question from Aubrey real quick in the chat.
Go for it.
Talking about the great migration out of California. So I definitely see that. There's a lot of people who did not like politically how California handled COVID. We pay a ton of taxes for our lovely weather here as well. So, we definitely have seen that. I don't have numbers offhand for that, but it's really I'm not seeing it having any impact on the housing market, because again, we just have such limited supply and such high demand. So yes, there are people leaving, but it hasn't yet had an impact really on our housing market that I've seen.
Great presentation. Thanks for the share, Kyle. That was really well-rounded. And we are over to Adrienne. Adrienne is in Albuquerque, New Mexico. Adrienne, thanks for joining us. Thanks for sharing and teaching us a little bit about what's going on in your neck of the woods.
You bet, guys. Yes, Adrienne Baird here. I am in the hidden gem of Albuquerque, New Mexico. And I've been selling real estate here for about 14 years. And so I actually started during kind of the end when the crash was wrapping up. So I've seen kind of the ebbs and flows of what's been going on with real estate here. And I'm happy to kind of share what we're seeing. We're seeing some similar trends in perspective to your larger markets. We're a much smaller market. And while we have seen an increase in inventory over the last year, I think it is important to point out that we're seeing a pretty heavy increase month to month here in Albuquerque with our inventory. So while inventory is going up quite a bit each month for us, as it should, with the start of summer kind of happening, we tend to see that. However, it's a heavier increase than we typically see. Our supply is still down a bit. We're looking at about just over 2 months of inventory. And our average days on market right now is 11. So we're still seeing things moving relatively quickly here. And then our median sales price is about $315. So that's increased from last year as well. We're in a bit of a smaller market. I loved how Kyle's is in the millions. I wish that were the case for us, but we tend to flip those a little faster. And I will say, to Jake's point as well, with the luxury market, I do a lot in our luxury market here in Albuquerque. And And I have a listing currently at 1.6 million, and we just got an offer on that yesterday. So I am happy to present that even our luxury market is still cruising along. It's strong. We don't have quite the income stream here in our smaller market that you guys do in your larger markets, but we have still that market moving really, really well for us. And so that's nice to see as well. Our average sale price is also increasing over the last year. The pricing in each of our markets and sort of like our sub cities are also doing the same thing. So if you want to cruise to the next slide, Josh, that would be awesome. Tell you a little bit about what's going on here in Albuquerque. We have our median price is increasing as well. Our average sales price is increasing. The important thing to point out here, what's happening in Albuquerque, is we have a lot of big things happening, which is really cool to see. We have some high-tech companies like Intel. They're doing massive expansions here, which is causing a lot of new jobs and new growth for Rio Rancho, which is just right outside of Albuquerque. Facebook just moved here recently, and they have a gigantic project happening, as well as the movie industry. We have a lot of incentives here in Albuquerque for the movie industry. So we're seeing a lot of investors here purchasing properties for executive rentals for the movie industry specifically. And all of those are creating a lot more movement to Albuquerque than we've seen in the past. So we're grateful to see that. We're seeing some, people moving out of our state due to various reasons, and we're seeing a lot of people moving into the state for various reasons. So I think we're seeing a good balance of good things happening here. I mean, even with the scare in the news and all of that, things are still really strong in our smaller market. So it's good.
I love it. Adrienne, I'm going to throw one more question at you. I
Yeah.
was reading a couple of articles last week, and one of them was talking about price reductions, and that there's a lot of price reductions are on the rise. So in your market, tell me what you're seeing, or share with us what you're seeing as it relates to price reductions. Are those price reductions, if you are seeing them, so significant that it would bring the real estate values down, or is that just bringing sellers kind of down to reality? What are you seeing in your market as it relates to price reductions?
Sure. Yeah, I'm happy to share that. I think we're getting back to a little bit more even playing field, kind of like Kyle was talking about earlier. So we are seeing some price reductions here and there. I don't have any statistics on exactly what those look like, but for the first time in a long time, we're seeing that. In fact, I even just I got a house under contract the other day for one of my buyers, and we actually were able to get some seller concessions for him. And I hadn't written an offer in about 2 years with any sort of, closing cost credit to speak of. So I think that's kind of cool that things are happening. And I think really what it is, Josh, is a lot of these sellers are thinking, oh, the market's so crazy, we're going to price our properties at this price point. And so now we're just getting back to more of an even playing field and a more normal price point, and then their homes are selling. So the market's really speaking for itself. I don't think there's like a problem in that they're dropping the prices. I think it's just they're dropping them to a reasonable price point so that the homes can actually sell.
Normalizing. And I know I speak for all of us, like, we don't want to see 20 and 30% appreciation rates. It's not healthy. It prices first-time home buyers out. We want to see a more balanced market, and we're slowly getting there. Although 2.2 months inventory, I'm not sure is quite balanced yet, but we're headed in the right direction.
Exactly. Yeah.
Thanks, Adrienne. That was awesome. We really appreciate you, and great job. Let's send it over to Chad Hedrick in Greater Houston, Texas. What's happening, my friend?
Oh, not much, man. Thanks for joining us. You and Jake there, y'all have been able to help us continue our education, striving to be able to lead our clients the best that we can. So this was a very inspiring, and encouraging thing for us to see the silver lining and how things are skewed in the market. We know our local markets, but it's also nice to see what everybody else is doing and see, how accurate the media really is, and how they're picking, negative things out of specific markets to give us fear And so that's what we faced a little bit and we're facing. And that's how we started this here. I called you about 3-4 weeks ago. I said, hey, you know what? We want the public to know the real story. We want them to feel comfortable purchasing or selling a home. And so I'm thankful you guys were able to share time. So thanks, guys.
Yeah, great job, everybody.
Yeah, the greater Houston market. So I serve the Woodlands and the greater Houston market. I run a team of 9 called the Gold to Sold Group with Compass, and we office out of the Woodlands, Texas. The Woodlands has been a significant place because we're the world headquarters for Exxon, one of the largest companies in the world. And we are obviously a big oil and gas town. With that, really creates a lot of stability where we don't see the drastic growth, but we do see just consistent growth. And it's considered, one of the most safest places, I would say, to invest in real estate. And as you can see here, with the change of inventory here, from May of 20, I went to May because that was recorded and I could pull out that rather than doing June. We went from 76.43 all the way down. I was in 2020 to 46.57. And now my toolbar here is in the way, excuse me for that. And now we're at 41.84. So it's not much of a difference between 2021 and 2022. And I think what's interesting about this discussion that we're having today is everything is so hyper local. And so when I say that, it's like every community, every city, every market is completely different. I talked to somebody selling condos in San Francisco and her business was absolutely dead. And so it's like, I called her talking about my market and I kind of felt guilty that we had such a healthy market and nobody was buying condos in San Francisco. So yeah, so we've had a reduction in inventory, was 11% from 2021 to 2022 and down 40% pre-pandemic. So we're seeing a median price of 651 and an average price per foot of 204. And as you can see, we have days on the market of 5 days. And I'll skip to number 4. Don't change the slide just yet, but number 4, it's a little out of order here. The average list to sold price is 103%. So that goes to show that we're still very, 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 very healthy. In fact, some of the listings, for example, I had one 2 weeks ago at 1.5 million. I put the coming soon sign out there. I got a call from somebody and I named the price that I would accept to take it off the market, which was $100,000 above list price, and they wrote the check for it.
Wow.
Absolutely crazy. So we're ranked number 1 for multifamily development. All these stats here are just showing, the health of the economy and the stability and the overall growth just year after year. And if you'll go to the next slide, I'll follow up on that. So we're the number 1, as Alex said earlier, we're the number 1 ranked market for relocation. Crazy stat, 4,100 people per month are moving here over the last year. So I just imagine a whole bunch of planes coming in and how many planes it would take for 4,100 people to get here. So that was an interesting fact that I didn't know. And then 19 homes were sold in the Houston area or Woodlands area this year so far, from 5 to 20 million, including some new ones here that we see on the bottom. But I think the reason that a lot of people are moving to Houston right now is the opposite of what Kyle said. We have unlimited space and we're able to provide acreage properties. We're able to provide space and we're able to give the best education, which is a big strength of ours here in Texas. Our education program is one of the best in the country. And then another thing is people are really following their political orientation. I hear quite often, and we're not gonna talk bad about California. Kyle. I'm just stating my experiences, but a lot of people in California think that their opinions don't count anymore, and probably 50% of my relocation clients are going somewhere where they have similar opinions. And yeah, it's been a great market here. We're not, like I said, it's hyper local, and we haven't really seen a dip much at all. There's a little bit of increase in inventory, but at the end of the day, we feel that all these stats here and all these people coming to Houston are a good comfort blanket for us moving forward.
Yeah, it looks like by the looks of these pictures, Chad, that these people are looking for the opposite of high density in these pictures right here.
I mean, we're talking when you're here and you've got a $16 million home, we're talking on 4 or 5 acres with a 15,000 foot home gated like that. You know, it's a completely different lifestyle, and we've got miles and miles of property. And it seems like people here in Houston, Josh, you visited at one point or another, but you probably realize how much you drove when you got out here to get from one place to the other. But that's the lifestyle that we have, and people have an appreciation for space, having a big pool in the backyard, and really, kind of the defense to the humidity is a big swimming pool in the backyard.
Hey, Josh, can I add one thing that's kind of blowing up in the chat right now? And I'm just going to summarize. I don't have a slide for this. But this is a great question. At the end of it, we go through all this data, and the comments are still kind of like, well, what about this? What about this that I'm reading in the news? Price is too high, and still, will it crash? We've talked data, so I'm not going to beat a dead horse there. Let's talk real life. And here's what I've experienced with customers. If you are buying a primary residence, there's advice for an upgrader and there's an advice for a first-time home buyer. For an upgrader, okay, your biggest factor is the interest rate on your current debt versus the interest rate on your new debt, okay? If you try to time your value, I'm upgrading to 800, I'm selling for 600. And you're sitting here going, that 800,000 house is going to come down. I'm going to wait for it. Cool. But what are you going to do with your $600,000 house while you wait for the 800,000 house to come down? People never think about that. It's like, unless you're going to sell that sucker and try to time the market perfectly and then go rent, which you're going to lose that money, and then cross your fingers that you can time a decline, it's not going to work out. Trust me, I've watched it for years, decades. The advice for first-time home buyers. That's the more difficult question, if I'm going to be brutally honest with you. And I'll take off my sales hat and just be real. I too sometimes go, gosh, can first-time home buyers afford this? But I think we answered that with Kyle's slide and some comments in the chat. Guys, the only bullet for affordability right now is density and smaller square footage.
Yep.
There's governments, municipalities, planning commissions, consumer-driven groups that are popping up that are trying to all advocate for affordability. And I'm sorry to be facetious about it, because trust me, I've been in those meetings and I've been on both sides of the fence. But if you're talking affordability for millennials and first-time home buyers and everyone that's going to flood the market, it's even going to make these inventory numbers crazier. If we got into that slide, because Josh and I have that in another presentation, the next decade is more buyers. The only answer right now is density and less square footage to make those prices more affordable.
Or you move to Albuquerque, New Mexico, and Adrian can sell you a $340,000 average house. Is that right? Because that's part of this great relocation, right? Is that, hey, I've been renting here because I had to go to an office. Now I don't have to go to an office. Now I can go to Albuquerque and I can buy a house and I can spend $350,000 or $500,000 and buy a nice house. So I think those are the only solutions, Jake. It's more density, it's smaller living space, it's living on top of each other, right next to each other, or you're seeing this relocation into places like New Mexico, Arizona, Montana, Idaho, Utah, those types of more rural locations.
Yep. And you got to factor, just my main point is you got to zoom out and factor all of the costs, all encompassing, not just, geez, this upgrade house is expensive, I'm going to wait for it to come down. It's a bigger It's a bigger equation than that. And lastly, if you're talking investors, that's a whole different set of advice. But my own buddy here, Josh Metals, said it best, and he's tired of hearing me repeat him because I've done this in many presentations. But as we've been buying commercial buildings the last decade, every time he goes, man, over 100 properties purchased. I still don't think there was ever a time that at the time of purchasing, I thought I was getting a good deal. You always think you're overpaying when you're like making the offer and trying to negotiate the deal. Always. It's only looking back that you go, all right. And here's the true, there's all these sayings about real estate. Like one of them is location, location, location. And I'm like, really? In my ghetto in Salt Lake, there was higher appreciation compared to the nicest area when we came out of the recession. So like, that's not an accurate statement. The question is, what are you looking to do with your real estate? And then we can talk location. But I would say the biggest factor, the biggest lesson in real estate we're addressing in the chat, it's time.
Yep.
Time heals all wounds. And the underpinning to that is, as an investor, do you have staying power? Everyone's like stoked when they have equity and the market's up. The question is, can you afford to hold and have staying power when it's down? If you can weather that storm, definitively, there's 100% chance that at some point you'll be out of it and make money. And if you look at century-long data, there's no better investment asset class than real estate, period.
Well, just net it out, Jake. If you're going to live in your house for 5 years or more, or if you have an ability to buy that house and rent it out and have it a positive cash flow in 5 years, your margin of error is so slim. Like your chances of losing money if you got a 5-year time horizon is incredibly slim. If you have a year time horizon or a 2-year time horizon, that's more risky. The shorter the time horizon, the more risk you have. But if you have a long time horizon, timing the market is not the way to go. It's time in the market that is going to be the winning strategy. Team.
Guys, I have one question for you. I was thinking about, and I heard something today, and from a mortgage perspective, I kind of want you guys to give some light on this. We're talking about going from 3 to a potential 6% interest rate. And with the market softening a little bit, rather than negotiating on price, and you have the chance to negotiate on closing costs and use those closing costs to buy down the rate to minimize that cost of ownership. What do you guys think about that strategy?
Let me jump in go ahead, Kyle. I'll jump in after you, but you give the real estate perspective. I'll give the mortgage perspective.
Sure. No, you're exactly right with that. And what I was just having a conversation with my team about today is that, it might not even be that hard of an ask for the seller. If you're not pushing your appraisal value, you can inflate that offer price and basically have the cost just baked into the loan, and then ask the seller to pay for the rate down, because that's a less of a pain point for the seller at that point, rather than a buyer to come up with the extra cash on it. It would be much better to bake that in the loan. And if we're not driving prices the way that we have been, and there's not a lot of competition on it, like why wouldn't a seller accept an offer that's presented as like, okay, you need to think about this as an $800,000 offer, but we're writing it at like $815 or whatever, and we're going to ask you to do $15K closing costs. So I think that strategy is going to be working a lot moving forward.
Yeah.
Kyle, I agree with you. I think you're 100% right. I've seen it in previous interest rate increase markets. And here's the numbers from a mortgage perspective, because we do these analysis all day long. Every dollar that a seller gives towards a rate buy down, and I'm talking about a permanent interest rate reduction, not a 1 year, 2 year, permanent. Every dollar that they give towards a rate that's used towards rate reduction is equal to $3 in reducing the price of the home as it relates to the payment. So if you're trying to drop the payment because a borrower wants more affordability and that's what's most important to that family, then $5,000 towards rate buy down gives an equivalent payment adjustment as $15,000 towards price reduction. So it's a 3-to-1 payoff. And hey, if we can get sellers to pay for it right now, I say go for it. I believe that we are nearing an economic recession. I don't think we're going to be hit like the previous Great Recession, which was because of the mortgage debt bubble. I think real estate will do well because there's still not enough supply and there's a tremendous amount of demand. But what always happens in recessions, like always, 100% of the time, is interest rates come down. So, you know, I think if we can negotiate it from the seller, great. But I wouldn't be writing big checks to pay 2 and 3 points to buy down my rate, because I think the odds are in our favor. We're going to see interest rates ahead. We've been telling clients, I'd love to know what you all think about this. We've been saying, look, marry the home, fall in love with the home, but date the rate, because we're going to manage that mortgage indebtedness for you. And the moment that that interest rate delta is enough that it makes sense to do a no-cost refinance, we're going to proactively reach out to you, help you restructure that and lower your payment.
It's good.
That's a big saying, actually, that's going around right now, the last 30 days in real estate, all across the country. I think Mike Ferry coined it, but it was marry the house, date the rate.
Yeah, it's well said. Any other questions in the chat that we should hit, team, or do you think we addressed them all?
I think we've been standing on top of them.
Yeah. All right. Well, this was a tremendous amount of fun. Alex, Chad, Jake, Kyle, Adrian, you guys killed it. I really appreciate you doing all the research and showing up to share so generously. I know people got a lot of value out of this. And thanks for all the attendees who joined us and all the incredible questions. So thanks, everybody. I think that's a wrap. And if you have any other questions, put the questions